This video is for all the doomsayers out there who are looking at the US Treasury yields and saying that a crash is inevitable. And most often than not, these same people, the YouTube gurus out there, they don't really give you an answer, okay, what you can do about it and what exactly is going to happen. They just look at this and then they say, this is scary, thanks for watching, see you in the next video. So in this video, I want to take a couple steps backwards and I actually explain why these are important or not so important, and actually what you can do about it. So I will be laying a lot of foundation here, so this is going to be a little bit longer video, so make sure to actually watch this whole video. And before I get started, I just want to say I'm just a guy on YouTube, and I also just want to understand the markets and make money here. So I could be wrong in my analysis. So if I am wrong and there's some smarter person than me, maybe some of the YouTube gurus makes a response video to this or whatever, I will be very happy to actually change my opinion based on new information as well, because I want to make money. I don't want to be just stuck in my own opinion on this matter. But looking at different sources of information, like Meet Kevin on YouTube has great videos. I appreciate the guy. He's sounding warnings, but not really saying what to do about it. Same thing with Eurodollar University. He's selling his own online course, but never really saying, okay, what do I do with this information? And then, of course, George Cameron with Rebel Capitalist and many, many more. And I love these guys. I watch their content, but I just don't understand what to do with the information. So I have to do my own analysis on top of whatever they are saying. So now let's take a look at the what is the 10-year and the 2-year Treasury yields. So when you take out the 2-year and the 10-year Treasuries, these ones here, you can see historically all the way back to 1934, you can track the 10-year Treasury yield. So whenever you give a loan to the government, it's called a US Treasury basically, and you get an interest rate just because of you loaning money to the government. And these rates can go up and they can go down. And for the last 40 years, we had basically a declining trend here, and that declining trend has basically reversed after COVID crash. So now the environment is completely different from what it was for the last 40 years. So if you just analyze these charts based on the 40-year data, you can see the market is already different because we are higher on the chart here, which means that the trend has pretty much changed. So we could be looking at a climbing interest rates for the coming years or even decades. We don't know. But anyway, just that for starters. And you can see the recessions here with the grain line. And the interesting part here is whenever these lines actually cross over, because when they cross over, it means there's an inversion of the yield curves. So when you track the inversion of the yield curves, it looks like this. So this is the inversions or crossovers of the 10-year Treasury and the 2-year Treasury. So whenever you see a number which is below 0, that means that the yield rate of the 2-year Treasury is higher than the yield rate of the 10-year Treasury. So what is the question, of course? Well, what they say here, let me see here. What they say here is that when you look at the 2-year and the 10-year Treasuries, it is a popular indicator which basically shows you mortgage rates and the consumer confidence. So on other hand, whenever the 2-year Treasury is higher on the yield, it means investors are expecting weaker growth, lower inflation, and easier Fed policy. So basically, again, this is like quite hard to understand. So the easy part here is whenever the number goes below 0, it is potentially a recessionary signal. Basically, whenever you see the number here going below 0, a recession might follow. So this has happened a couple times in the past. And you can see they are actually saying it here that this has happened 8 times. It has predicted a recession, but 2 times it gave a false positive. So it's not 100% accurate indicator, which is the first thing to note here, is that for now it has an 80% success rate as an indicator. And just like I said before, the market has already shifted from a declining rates to climbing rate trend. So things are already a little bit different. But what they are saying here as well is that nowadays it could be even better to take a look at the 3-month Treasury against the 10-year Treasury. So let's take a look at both of them. So here you can see this is going all the way back to 1976. You can see there was an inversion where the 2-year Treasury went higher than the 10-year Treasury, and then we had a recession here and another recession here. We had an inversion here and followed up with a recession. Then we have had an inversion here, which was not followed up with a recession immediately. And then you had a bigger inversion, and then you had a recession here, and the same thing with this time period from 2006 to 2009. And during COVID, we had a small inversion here, followed up with a mini recession. And now, as you can see, we have a massive inversion with this chart. But we currently don't have a recession, at least officially. So what most gurus out there are now speculating is that we will have a recession very, very soon, maybe within 3 months to 6 months. And of course that can happen. And I'm also playing the part where we will have a recession and there will be a crash. But if there's going to be a banking crash, will you want to keep money in a bank? That is also a question, because if you just have stocks may fall down, they may crash, but what kind of a crash are we talking about? So let's actually take a look at the S&P 500 index, and let's see previously when we had an inversion, what was the crash actually about? So here we have the S&P 500 index, and now we're looking at all the way back to 1960s here on this chart. And here you have the inversions of the 10-year and the 2-year, and below here we have the inversions of the 10-year and the 3-month treasuries. So when we take a look at this, first off, when we're looking at the inversion from 78, there basically wasn't any crash, even though there was a recession. Because what we are as investors interested in, of course, are we making money or losing money? So a recession doesn't necessarily mean that you're losing money and it means that stocks are crashing. It might be that the stocks already crashed and then we had a recession afterwards. So here you can see we had this inversion, but the stocks never really even crashed. Like the maximum crash we had was during this time from this peak to this bottom, which was only 26%. So here, basically all of whatever was happening here didn't matter at all. And then we look at the next one from 88, 89 during this period of time. You can see we had a crash before, which looked quite terrifying. It was a 32% crash. And that crash, you could not even see it on the inversions chart here. So that wouldn't have helped you at all. And when the inversion actually happened, and if you had bought stocks here during the inversion, wasn't so terrible. That wasn't a terrible idea at all, because the maximum downside you were experiencing here was only 21%, which might have been scary. But look at the upside here. You're looking at the 300% gain. You took 20% downside, but the upside from there was 300%. So if you just based your investing that you cannot trade because there's an inversion, we already see 2 times where basically it didn't give us a correct signal. And then let's take a look at the next one, which was right here right on the inversion date, we did have a crash. So this was a little bit accurate. Let's see how big the crash was. 20%. Not massive, it's still a crash. This tiny bit here. And then we had another inversion, and this one was major. So here, this was a 50% drop. So this inversion which happened here, if you had actually taken action during this time, that would have saved you 50% on your capital if you were invested in the S&P 500 index. Then we had an inversion here from 2006, and of course then we had the great financial crisis, which took the stocks down all the way about 55-58% here. Now what we're looking at, of course, we had the COVID crash, then we had the inversions again. So if you actually took this advice and took your money out of the stock market during this inversion, maybe you would have saved 28%, 30%, 35%. But afterwards, what happened? There was a lot of money printing in the world, and then you're looking at an 100% to the upside here. So right now, the S&P 500 index, it is making all-time highs again, and we are still looking at an inversion here on the rates. So now the question is, okay, now we have mixed signals here throughout the times. It has been accurate, it hasn't been accurate. What's the pattern here? And to be honest, I don't really see a pattern. I was looking deeper into this situation here, and when I looked deeper here, let's actually take a look at, we are looking at the Investopedia here. This was the mixed signal I got, is when you see interest rates or the treasury yields rise, it means investors are bullish about economy. So now I'm thinking, okay, so if the rates are going up, that means investors are bullish on the economy. If they're bullish on the economy, that probably means the stocks are going up. So when the treasury yields rise, they go, it's bullish because the demand for the government loans is low, because that's why they have to raise the interest rates, because they need money. So they raise the interest rates to attract more money for the United States government. And when that happens, private money is a better solution. So they take private loans, and that is causing the rates to go up as well. But now they want to lower the inflation rate in the economy as well. So there's that situation. So now we're looking at so many different variables. So let's actually simplify this. How does that sound like? Let's simplify all of this, because in my opinion, this inversion doesn't really give us an accurate information. So now let's take a look at something simpler, which is the M2 money supply. So we're looking at how many dollars are there in the market completely. So 2020, we had the market crash. Then what happened is the money supply went from 15,000 billion, which is like $15 trillion, to $21 trillion. And now we're basically going sideways here with about $20 trillion here. So this is what is causing the inflation in the asset prices. When you see a lot of money supply going upwards, so now it is completely up to whatever the country decides to do. Will they actually keep going sideways? Because if money just goes sideways and the interest rates are high, it means that the money is actually taken out of the market, which means that assets go down compared to United States dollars. So if that's the case, then markets will crash if this just goes sideways or downwards. If they decide to pull the trigger again and start inflating the supply, then markets eventually will recover and go upwards. And this chart here will always go up in the long term. in the short term, they may make whatever decisions to hold money printing, but eventually it will go up again, just because government is always running out of money, as you've probably seen. They always overspend and they never budget. They just overspend and they cannot get enough money from taxes. So when that happens, they have to issue new money. We saw that during the COVID crisis. Donald Trump was the first president to initiate the money printers, and we're currently waiting whenever they start again. Euro is in the similar situation. They're currently not printing money, but China here, they are just actively printing more and more money. And now let's simplify it even more. Let's go over to Twitter. Because on Twitter, let's take a look at this animation here. This is the G7 countries versus BRICS countries when you compare to GDP. So this is a short clip that shows the difference between the G7 countries and the BRICS countries in GDP. Let's actually just go a little bit, and here you can see something interesting. 2020. Based on the GDP, BRICS countries are the biggest economy in the world right now. So this is the major trend, more important than what is going on in United States, in my opinion. We're seeing a power shift, economical power shift, going from the West to basically other countries in the world. And some people may like it or may not like it, but this is reality. So we need to look what other countries are doing as well, not only what United States is doing. So what you can see here, this is the chart of the day. This is also from Twitter. This is the value of the currency in Nigeria. And you can see this is the axis from 2020 to 2024. So this jump here is 1 month. So the price has completely plummeted. And this is because the country of Nigeria is printing money like crazy, which means that the assets are going upwards compared to the currency there. And another thing which I posted on Twitter as a response to this one is that Nigeria, for some reason, is also the global leader for Bitcoin trade. This was an article from 2021, but it's still true. And why is that? Because Bitcoin is sound money and you can trade it cross borders, you can take your money everywhere, and it cannot be confiscated as long as it is in your cold or even hot wallets. But anyway, Bitcoin is basically the answer here. And Bitcoin is where global money is going towards, with the ETF announcement, with these other countries which are gaining more GDP compared to the G7 countries. So that is the big trend here. So in the short term, sure, there may be a crash in the S&P 500 index. Sure, we could see something like this. Let's take out this. I will plot this for you, because if we just draw here a couple simple lines, you can see we're making a new all-time high here. But what we could be seeing is like this. It was like a double top, and then we had this major crash. But it could also be something like this here. This area here, actually, I should have kept the inversions, because the inversions, let's actually put them back here. The inversions were aligning. Let's do this and move it to a new pane below. Here, let's change this to regular, and let's put the line here. You will see something quite interesting. 0. So let's put this back to logarithmic view. So here you saw the inversion, right? And what happened here afterwards? This looked like a double top, or it could have been a double top because of the inversion here, but then the market just kept rallying. So which one is this? We don't know. We don't know. But eventually money is moving somewhere else besides outside of United States at the moment, outside of the European countries. It's going somewhere. Bitcoin is at the center of all of this. It's outside the control of central banks, and a lot of people are losing trust. And one more piece of news that I just want to give you is the bank that just crashed here. Let me see if here, the New York Community Bancorp stock, and this had a drop about 40% just in a couple of days, 36% in one day, or was it in one day? Well, anyway, it's down a lot, and this just happened also 14 hours ago. So here, what's the important part here is that they made a loss when they were supposed to make a profit. So they made a loss of 36 cents in one quarter when they were expected to make a 28-cent profit per share. So that's why the price dropped. But when the banks are all interconnected through loans, they are loaning to each other. They are loaning to companies who have loans from many different banks. So when one company goes under, that means the banks are in trouble because they have a deficit in their balance sheets. But the important part here is that this was a bank, and it looks like they might be in trouble. So this means when you see trust in the financial system going down, people will look for alternatives. And before, it used to be gold, but nowadays Bitcoin is becoming a very interesting alternative because anybody can open a wallet. And now with the ETFs, that's even more prominent. So in my opinion, yes, there may be a crash. So it's a good idea to play against that. But in my opinion, it's also a great idea to actually try to play in case if there's a crash. So you may want to have some dollars in different banks. You may want to have currency outside of whatever country you live in an offshore bank, or in a global, like a monetary, like wise.com or some other platform. And you may want to have money in Bitcoin and gold as well. But in my opinion, Bitcoin looks to be at the center of the big trends, bigger than whatever is this 10-year, 2-year yield inversions. So this is basically my analysis and my understanding of this whole situation with the 10-year, 2-year yield inversions and whatever people say about the stock market crash. So it may happen. I'm not saying it won't, but I'm also saying that, okay, recession might come, but it doesn't mean that the stocks will crash also. So whenever you watch videos from now on, try to understand yourself what's going to happen and tell me also what's your opinion, and let's try to figure this out together as well. I hope you like this analysis, and I'm very eager to read the comments, and I will make another video when someone tells me that I'm wrong and I agree with that statement. But anyway, let's continue the conversation in the comments, and I will see you on the next video. Cheers.